Okay, so thanks everyone. Just going through my presentation initially to set the scene. The photos you can see there on the screen are photos from our grassroots tour in 2019, where we took people to regions like Mumbai, Bangalore, which are, prominent cities in India as part of our tour. Just a little bit about India Avenue and what is our mission. Our mission we see as to provide superior customized investment structures for Australian and New Zealand clients, ideally to benefit from the growth story of India. What we're trying to do is help them to decide whether they should invest in the region, how best to implement that decision, and how to determine what might be an appropriate portfolio allocation. Our grassroots experience we see as an educational piece of what we do. It's helping our client network with connectivity to India, understanding the local ecosystem better. And as I said, we did that physically and also via grassroots, the virtual format, which we have been doing as in lieu of the physical tour. And essentially the grassroots gives us and our client network access to local insights, expertise, capability, and getting to meet, in this case virtually, but sometimes when we've done the tour physically with advisors to the Indian government, central bankers. We've had meetings in the boardroom of the Reserve Bank of India with fund managers who are experts in their domain and the territory, strategists of investment banks and brokers, industry consultants, and company management chairmen, CEOs, of some of which you will be virtually meeting today. In terms of our philosophy and proposition, this simple chart will indicate long-term what we're trying to achieve. We think there are three tenets of our philosophy. Firstly, India is expected to be a strong economic growth region for the next couple of decades due to its low dependency ratio, young population, economic reforms which should make it more productive, and a highly employable population. These fundamentals should mean that economic growth is high, and the compounding earnings growth that companies can make due to these fundamentals should generate decent returns from India's capital markets. From an active management perspective, we do think markets like India are less efficient than the typical developed markets, and therefore active managers can produce superior returns in the long term to investing comparatively to an ETF or a passive type of structure. We also think that locally based investors are able to generate better returns in the long term due to their knowledge and insight, which should be superior to global investors seeking to invest into India. The chart on the right shows if we went back in history and looked at the advice structure that we currently operate with, and I'll explain a little bit more of that on the next slides. You can see that the active management return that one achieves by investing in India actively is far superior in our view in the long term to investing in an index, which still makes decent money from investing in India, but the active return can be far more significant. Just a quick word on our process. As you know, our process really relies on our skill sets of assembling a portfolio and constructing it, as well as our strong partnerships with locally based investment advisors who have been managing money in India's ecosystem for a decade plus. We try and identify, in our case currently, 3 highly skilled advisors with complementary types of investing styles, and we build them into a portfolio. We don't invest in their funds. We obtain advice from them, and all the trades and all the stocks belong to us. So it's essentially our portfolio, but we understand that it's very difficult to sit in an external region and invest successfully in the long term in a market like India. So that's the reason we do things this way. and we feel it allows us to be close to our client base as well as close to our investments through our connections with our advisors. Just to give you a background in terms of profitability, GDP growth, and alpha, there's a lot of discussion around, is GDP growth necessarily linked to profit growth, and where do fund managers stand in the cycle in terms of when they do well and when they do not. In our view, in India, the GDP growth in the long term does have reasonable linkages to corporate profit growth. If I look at GDP growth over the last 25 years, it's averaged about 6.5% to 7% real. And when you look at earnings, the compounding EPS has been around 10 to 11% as well. So, and that's obviously when you adjust for inflation, it's around roughly the same linkage or fairly highly correlated. So when we look at this chart, we can see that corporate profit growth during periods of high corporate profit growth, generally that's when alpha or active managers who are based in India tend to do well. Ideally, you have GDP growth, corporate profit growth, and alpha correlated to each other. Over this period in history, the active return from locally based advisors has been quite high and has averaged around 5 to 6% over a fairly long period of time. So that's why we like the local advantage, and we feel that India is very much an active market. And typically, when this active skill set will work is when GDP growth is in line with expectations and profit growth is reasonable. There are periods like 2018 to 20 where GDP growth fell in India from 7 to 3%, and profit growth was weak, where perhaps it's a difficult environment for active managers, but that can turn around fairly quickly, and you can see some of the alpha numbers can be quite significant when the local advisors are able to identify growth stocks and high dispersion between successful companies and less successful companies. You can see on the charts on the right that profitability after a period of slowdown really in the last decade and being driven more by rising PEs rather than earnings, that's starting to turn post-COVID. Corporate profitability is starting to rise, and GDP growth, which was to some degree profitless in the last decade, should now be far more effective in terms of GDP growth transpiring into bottom line going forward. So we think it's a good environment for active management as well as a result. When we look at our results as India Avenue in our 5-year history, you can see that the periods where the fund has outperformed relative to a benchmark is those periods where markets are either in a normal phase or in a period of acceleration. Periods where the fund has been impacted from an active perspective is when India's growth slowed dramatically, as I said, from 7 to 3%, and during the couple of months of COVID, when again, India's growth slowed. So our view is in the long term, it's better to be active and better to be aligned to the growth story and identify those who can pick the eyes out of growth stocks, because that's really what investors come to India to buy, and that should provide the best results from a longer term perspective. In terms of our knowledge package, what we provide to clients, being a focused manager on India and only India, we have things such as a monthly fact sheet, which you would expect of most fund managers, webinars, which we run half-yearly, research notes and white papers, which we write ad hoc, which are based on educating, providing insight and knowledge, and perhaps thought process of how much to allocate, what should be wise from a portfolio perspective. We're frequently in the media through Livewire and Ausbiz and writing stuff on LinkedIn. We run these grassroots tours and write a grassroots note research paper half-yearly. And, I think one of our biggest advantages for our client network is the access to local experts, which we can provide on an ad hoc basis to help them really navigate and understand these markets much better. And that's what we seek to bring to the table. Final slide. Really, what do we expect out of this decade? India will become the third largest economy in the world after the US and China. India will increasingly play a more important role in the global supply chain. Today, China is 30% of manufacturing. India is only 3%. Manufacturing is 15% of GDP. The government wants that to rise to 25%. India, you can see through its exports already post-COVID, is starting to up the ante and be an interesting alternative to China. By 2030, India's population will have one of the lowest dependency ratios in the world. That means the number of employable people relative to those not employed will be quite high. Reforms which have been undertaken aggressively by the Modi government should unlock efficiency and productivity gains. You've seen population growth now less than 1%, and nominal GDP set to rise over this decade around 10%. So that should lead to a rise in GDP per capita, which has been fairly compressed till now. There should be a massive increase in financialization of savings. As you know, most people have a bank account, they have a national identity, they have linkages to a smartphone and a mobile phone. And currently, financial savings is only about 5% of household wealth, whereas in the US it's about 40%. So over the next 10 years, we should see significant shift of savings into financial markets, which is positive for equities. Entrepreneurial and tech capabilities will allow for several unicorns to emerge, and several of them will be listing over the next few years, all benefiting from internet penetration, which is now above 50%, smartphone penetration above 75%. So the digitization of India has occurred. Corporate profitability, as we saw before, reached a cyclical low point and is starting to rise. That should be beneficial, particularly as India's GDP is set to rise towards the US 5 trillion mark from the 3 trillion mark it is today over the next 5 years. Industries like pharma, data storage, autos and auto ancillaries, electronic equipment, chemicals are on the way to becoming global leaders in their space. Pharma probably already is. Some of the other industries I've mentioned there should be over the course of the decade. And importantly, India's market cap from today's 3 trillion should be able to hit 5 trillion and be the third largest in the world after China over the next 5 years. So we will see not only from a GDP linkage, from corporate profit growth, which should increase and become more efficient and effective and have greater productivity built in, but also from the several new listings and perhaps a rise in the weight of sectors like consumer tech will lead to India's markets being much higher and more recognized from global investors and have a higher component of local investment through this financialization I spoke about. So it looks like it's going to be a positive environment for India going forward. But that's enough from me, and we'll hear more from the local experts as the session goes on. I'll now stop the presentation and ask if there are any questions that you can send through via the chat box. Okay, we have a question. Is urban India still on track to be fully vaccinated in the near term? So today, urban India is about 70% vaccinated. Broader India is about 40% vaccinated. I would expect by October, November that everyone over the age of 20 is likely to be vaccinated in the urban centers in India. Gaurav, do you have a a view on that? Gaurav is our partner from Spark Capital.
Yeah, thanks, Mugunthan, and it's a pleasure to co-host this grassroots tour with India Avenues team. So you were bang on with the numbers. In fact, we did a further slice and dice of this to look at the top 15 cities, which are like the economic center of India, and for them also the number is quite high and almost reaching a level where the adult population is now vaccinated. In fact, ICMR, which is the key agency monitoring the COVID pandemic in India, they recently released a Zero survey wherein they are talking about a good 70% plus of pan-India population to have some sort of protection either in the form of antibodies or vaccination or both in some cases.
Okay, thanks, Gaurav. Just a couple more questions. Talking about the fund allocations and type of size of companies that we look at. So typically when we look at our fund today, about 50% of the weight of the fund is allocated to Nifty 50 stocks. So that's the top 50 stocks in India by market cap. Typically, if you're investing in an ETF or a passive structure, it'll be closer to 80 to 100% invested in that space. That is about 70% of India's overall market cap. We also have 50% allocated to the rest of the market, which includes the mid and small cap companies. Our view is overall in the long term, that's where the growth potential lies. However, that's not to discount some of the larger companies where there's still strong potential for ongoing growth. So it's to answer the question, it's really a mixture of the two. In terms of climate change and India dealing with it, I think India is one of the few countries that, because of the nascency of its evolution with climate change, that is on track to measure up to, the agreement that was signed in Paris. There's a very big shift towards renewable energy at the moment from, fossil fuels and I suppose conventional forms of energy, and it's probably going to be a significant growth area in areas like solar and wind and electric or lithium-ion batteries and I suppose areas that are going to be more focused on developing renewable energy going forward. One other quick question before we end the session and pass it on, because we're trying to keep everything on time, is views on the rupee. I think the rupee, people who invest in our fund are essentially exposed to Indian stocks and Indian rupee, because we run predominantly almost always an unhedged portfolio. So the Australian dollar has been very strong post-COVID, and as a result, relative to the Indian rupee has been quite strong. Going forward from here, the rupee and its macro position of India is in a decent position. They have strong level of foreign currency reserves. The current account deficit is no longer significant. Oil prices may rise and may create a bit more of a deficit, but from a foreign reserve perspective, they're in a very strong position. So longer term, we're not necessarily concerned about the Indian rupee being weak. The Aussie dollar does have a mind of its own and is more commodity influenced. So it depends on your view on commodities rather than necessarily your view on India. So with that, and with the intent of keeping the flow going, I will pass it on to Gaurav for an introduction to our next speaker.
Yeah, thanks, Mugunthan. Hi. Hi, Dr. Anand. Hi,